In my goal setting, if it is the case where I'm only doing 17 and a half and 20, either fix it then or create a goal and a strategy to get to that 20. Let's accomplish your goals and let's not wait till October to do that. We're back, baby. It's tax planning 2024.
All right. So
I'm Bill McGill. You are?
Brandon Chastain. They know who we are.
They better know who we are. We're coming.
I need to, sorry for the noise. I'm going to pull this a little bit closer to me here. All right. So money therapy. Today we're going to actually talk a little bit more about like the financial like things to do.
Yeah.
So this is a little bit more or less about the
philosophical
behavioral side of finance and more about the things to do. So again, hitting the ground running. We're in 2024 and it's the beginning of the year. So if you're a typical like W-2 person, especially like, younger family kind of, different things, like you might be looking forward to tax time because your tax time is a couple forms and generally a refund, right? So for all of you people, congrats and whatever. I'm jealous.
We envy you.
Yeah, I'm jealous. So tax time can be a lot, but what I really want to focus on today is the first introduction. We'll probably do another one towards the middle of this year. But I want to start to introduce the idea of tax planning versus tax filing.
Yeah.
All right. And I will say this, if you file your taxes, that is a reactive place to be. You're showing up, you're putting in numbers into a thing, and then the thing is telling you how much you owe or get back, and that's it.
Sure.
Tax planning is proactive in that we're trying to do things throughout the year that can reduce our tax liability. I am not suggesting we cheat on taxes,
right?
But there are things that our wonderful government has said, if you do these things, you owe us less, right? And so the question is can we do these things? Can we do them the right way? Some of these things you're probably already doing. It's just you're not doing enough, or you're not doing it the right way, or you're not annotating, or it's about the how you're going through the motion,
right?
So it's not showing up on the tax form, and so you're not getting any credit.
Yeah.
So you're still doing the same things as your next door neighbor, but he's paying less in taxes because he's just putting it on the form the right way.
Yeah.
So that's really what we want to try to focus on here.
We're trying to get proactiveness.
Proactive.
It also has to do with, when we talk about budgeting, there's a big difference, especially with the clients that we work with in financial planning realms, when people either, they get to the end of the month and they look at, oh my gosh, I spent X amount, as opposed to the couple or the person that goes, I know that I spend this amount every month and next month, this is what I'm going to spend.
Yeah.
It's a huge difference. It may be the same number, but one's proactive, one's reactive.
So the mindset here is a couple things. I just want to be really clear. I love being generous, but I'll never give the government more money than I have to.
Good.
Right? And on the same side of that, I'm a law-abiding taxpayer.
Sure.
I will pay what I owe.
Doesn't mean you like it.
But I'm not going to give away. If I'm going to give away my money, I'm going to give it to people that need it, not a government that wasted.
100%.
So that's what tax planning is. It's about keeping more on my money to do things that I know will impact either me, my family, or the people or institutions that I care about.
Yeah, finding ways to legally reduce your tax consequence.
Yeah, I just want to stress that because we're not cheating here.
No,
all right,
we don't cheat.
So let's start with beginning of the year between now and tax time, tax filing. So really, and there's people that are going to file extensions, but really we're just talking right now about like what can we do in the first few months,
sure,
leading up to tax filing deadline without an extension, and then maybe in the few months after that, because I think there's there's part of tax planning that also comes into like Q3, Q4, and that's
Yeah.
going to probably be a second episode.
Sure.
But in the beginning of the year, the first thing, everyone should already have this. So we're halfway through January. The first thing that I do every year is I get like a little file folder and I just write. So right now, January 2024,
Yeah.
I write 2023 taxes.
Yes.
And I put that on a folder and I put that folder on my desk.
Yeah.
And every time I get a piece of mail from something with a tax form inside of it, I just slide it in that document. Okay.
Perfect.
So it's very simple.
Yes.
Because this is going to be everything I need to take to my tax preparer.
Yeah.
So that's just step number one. Very, very simple. Now, last year, into last year, this is probably like 4 or 5 episodes ago, we did like a down market
Playbook.
episode. That's the word I'm looking for. So we did a down market episode, and we talked about how at the end of the, we talked about tax loss harvesting.
Yeah.
So with that, we just said, hey, we're going to throw in a couple end of the year things. So we did say, like the biggest thing is at the end of the year, it's already too late, but those FSAs can have like a use it or lose it kind of thing.
Yeah.
So we're kind of moving. There are some things that we have lost the ability to do because the calendar year has changed, but there's so much that we can do for 2023.
Yeah.
For the first quarter of 2024,
Yeah.
up until tax filing day.
Yeah. And if you don't, we say FSA and HSA. What we mean by those is health savings account and flexible spending account.
Yeah.
And both of those are designed usually to be used for the healthcare, and it's for people with high deductible healthcare, plans through their employer. So if you don't know what that is, go to Investopedia or something and read up on it, because those are triple tax advantage vehicles. So if you go, hey man, darn the year's up, but hey, this sounds really interesting, get learning about it now or contact us. We're more than willing to educate y'all about that. So get on harpethwealthpartners.com and email us, because it can be a huge part of that tax structure. You get a tax deduction for it most of the time. You can grow that money tax deferred, and when you use it for the things that it's allowed to be used for, it's tax free.
Yeah.
It's the only thing in our society that's triple tax efficient. It's insane. You need to take advantage of this, most of you out there. So get more information on it. The best time to plant, a tree was 30 years ago. The second best time's today. So
yeah. Arbor Day. It's not Arbor Day. All right.
Johnny Appleseed Day.
So the next thing I want to talk about is maximizing your qualified account, your retirement account contributions. So what do we do at the beginning of the year? Okay. So first of all, we actually, for some of our retirement accounts, have the ability to make contributions for the previous year until the April deadline.
Yeah.
Okay. So even if you extend and you have a business and you have like a SEP account, that deadline even pushes further into the end of the year.
Sure.
So with that, at the beginning of the year, I'm questioning, did I max out last year's retirement accounts?
Yes.
And if I didn't, what can I do to make sure I max those accounts out?
Yeah.
The other thing is, with new years, frequently, not always, but most of the time, there are adjustments to the allowable contributions to all these accounts, whether it's a 401k, an IRA, a SEP. They typically go up a little bit every year, every couple years.
Yeah.
So in the beginning of the year, I want to know, did anything change about my retirement accounts for the allowable contribution? For example, was it last year or the year before where personal IRAs went from 5,500 to, was it 6,000 and 6,065, or did it go from 55 to 6,500?
Well, when we started in the business, it was 5,500 for people.
So over
under
the past
50.
several years,
but just over from in the year of 2023, it went from 6,000 to 6,500 if you're under 50.
If you're under 50.
If you're over 50, it's 7,000 to 7,500.
Yeah, you can do the extra $1,000 catch up. So some of us have
Yes.
aged. So maybe you were 49 and now you're 50. So you get that catch up contribution.
Yeah.
So contribution limits can change. And again, I'm a huge advocate for automating savings.
Yes.
If you want to like make this easier, automate, automate. And when it comes to my retirement account contributions, that's an automated thing. So in the first of the year, if I was at an allowable contribution, max allowable at 6,500 into my IRA, and now all of a sudden my max allowable because I'm 50 is 7,500.
Yeah.
I obviously need to go into my account and adjust that automatic contribution from, $580 to $673, whatever it is. I'm not doing that math on live podcasting stuff.
Yeah.
So make it automated, but you do need to spend some time in the beginning of the year, because if you don't do it now, next thing you know, it's going to be October, November.
Yes.
And you're going to be $4,500 into a $7,500 allowable year. And you're like, man, like it's Christmas time, it's Thanksgiving time. How in the heck am I going to come up with $3,000 at the end of the year to finish maxing this out? So we pay attention to it in January. We're paying attention. Did I max it out last year? Did I intend to? And do I have available resources right now to finish maxing out my prior year contribution? And then I'm looking, did any of my contribution limits change? And do I need to change any of my automated savings to make sure I'm on track?
Yeah. I want to jump in here and say a couple of things. We talk about, what we call maxing out an IRA or a 401k. And I would tell people, don't feel bad if you're not maxing those things out, but I would tell you to do a couple of different things just for your own knowledge and things. At this point in the year, when you're looking back through your tax, and you're doing this thing with your tax professional or your financial advisor, figure out what percentage, we talk about automating savings, figure out what percentage you're putting in to your 401k, your IRA of your income. Brandon talks a lot about the Elements app that we use. That will do it for you. You just put in the numbers. It tells you everything you need to know. But also the other half of this is figuring out with your tax professional and your financial advisor, obviously for the retirement piece, what percentage do I actually need to be putting in to accomplish those goals? So if I need to be putting 20%, but I'm only doing 17.5 as it turns out, okay, where can we put that extra income? What can we do to get to that savings point? This is part of the year where that revelation can come to pass. And again, we use the word recalibrate for a reason. And what I would do is within my goal setting, if it is the case where I'm only doing 17.5 and 20, either fix it then or create a goal and a strategy to get to that 20. Let's accomplish your goals and let's not wait till October to do that.
Love it. The next thing that I think is important here is we want to review and make notes about prior year tax activities.
Yeah.
And any changes to those tax activities. And the reason why I want to spend time making a list, or if I work with so for me and my clients, I actually do this for them. I let them know things that we did differently last year to impact reducing their taxes or trying to control their taxes if possible.
Yeah.
I give them that, but I also give it to their tax preparer, their CPAs, because I don't want anything to get missed.
Yeah.
If you're not working with somebody and you're a DIYer, like if you're not ready to start working with somebody, like make sure you're doing this, and you need to keep track of these tax activities.
Yes.
And the biggest thing to note, because here's the thing, I see this is really big in the financial industry. I always say there's like 3 critical mistakes that almost every financial planner I have met in my life makes at least one of 3 mistakes. And one of those mistakes are they assume that because things were done a certain way in the past, they're getting done the same way now, or they even should be.
Yeah.
So with that being said, if I'm recording my activities and recording changes and making adjustments, it's a summary sheet I can give to my tax preparer. They can know, like I can have more confidence that it's going to be annotated on the tax document, the tax filing document. So for example, right, if last year, I'm retired now, right, and I did not have to worry about RMDs, but then all of a sudden this year, RMDs became a thing,
Yes.
I need to write, because that is a taxable activity.
Yes.
So I need to write down that I took my RMD, and I need to write down how much I took, when I took it. There should be a tax form I get from my IRAs
Yes.
that will say, hey, this is the RMD that you were supposed to take. Here's how much you took. And I can also give that. But if I write that down as just a quick summary, I know it's not going to get missed. So that way I can avoid, because if my tax preparer misses that, the IRS could come after me to charge me for a penalty.
Yeah.
And then I'd be like, no, I took it. It was just not on the form. So then I have to go through this audit process, and it takes months to undo, and it's just a headache.
Yeah.
And nobody wants to deal with that when they're retired.
Yeah.
So we're going to write down. So the way that I do it, so it's 2024 now.
Yeah.
So I'm going to write all my taxable activities from 2022. I got a little spreadsheet, right? And then for my 2023 year, I'm going to write down all the taxable activities. So it's very simple for my tax preparer to see everything that I did in 2022, and then everything I did in 2023, so he could know, oh, hey, Brandon gave to charity in 2022, but he didn't in 2023.
Yes.
Or he didn't, Brandon's retired now. He didn't take an RMD in 2022, but he did in 2023.
Yeah.
So this summary sheet can be very, very good. Key things: qualified charitable distributions, IRA contributions, like the donor advised funds, and RMDs. If you had an income change, that would probably be something you want to annotate.
Yeah.
If you did a 60-day rollover, whether it's moving from like a 401k to an IRA, or like last year I had a client, they needed to do some things because they were, doing some real estate transactions. They needed to pull money out of their IRA.
Yeah.
And they had it back within 60 days. So it was just like they basically borrowed from their IRA. They had it back in, so they avoided any kind of early withdrawal penalty.
Right.
But we want to make sure that's documented, even though it's kind of a non-taxable event. If it's documented the wrong way, or if the wrong form, if like one form shows up and the other form doesn't, all of a sudden there could be a big miscalculation on your taxes. So we want that summary sheet.
Yeah.
That's it.
Yeah. I would say, even if you're a little concerned because you don't know exactly everything that we're talking about here, any major life changes is a good opportunity to talk to your tax professional and your financial advisor. So if you have a kid, if you get married, if you get divorced, if you change a job, if one spouse stops working for one reason or the other, if you make a larger donation to your church, more than usual, ramping up those things, you max out your IRAs for the first time, you got to take an RMD. If any of those things happen, just write down that something in that area happened, and make sure that you talk to make your financial advisor and tax professional aware, and we can help you get the most benefit and bang for your buck out of that.
Yeah, I always have a little bit of empathy for like my CPA friends out there.
Yeah.
Because I get to see my clients on like a monthly or quarterly basis.
Yeah.
And we get to talk about so much.
Yeah.
So I'm staying well read into marriages, divorces, loss, inheritances, job changes, children, all this stuff. Like I'm very read into my clients' lives.
Yeah.
They're seeing their CPAs once a year.
Yeah.
And so not only am I like aggregating a form of transactions that occurred that I think the CPA should be aware of, but I also like just to write a quick paragraph.
Yeah.
Of like, hey, the client's really proud of this, or the client went through this year. Like, so that way when they do sit down, like CPA, people always kind of make jokes about how CPAs are super dry and impersonal, and but it's like, it's probably awkward because they haven't seen you in a year, and they're just showing up and they're looking at numbers, making assumptions, or making, they're understanding your life through numbers, not through the humanness side of things.
Right.
So I like to write like a little blurb about, hey, if you sit down with, Sam and Sally,
Nancy,
like they're really proud their kid graduated college. You might just want to say, hey, I'd love to hear more about that, and let them connect, because then stories, and it's just a better relationship. But just understand, like, if you're a DIYer, your CPA might not have seen you in a year.
Yeah.
So surmising your life for the past year, add everything, have a conversation about it. They'll appreciate that.
Develop that team around you of professionals in this time.
Next thing that we're going to do is obviously file our taxes.
Yes.
If we don't have to, but we want to make sure everything's reviewed. We want to work with that. If it's a tax filing service, a lot of these online services, you can have like certain audits done might cost you a couple $100, but part of that oftentimes is just that peace of mind knowing, like, guys, I got audited. It's probably been a decade ago now. I was in the military and moving around a ton and then deployed. So I filed taxes, and a couple years later, I'm abroad. And what ended up happening at one point was a tax form was mailed to me that I had no idea was coming to me.
Yeah.
But when you receive a piece of mail, a tax like a 1099
Yeah.
in the mail, the IRS is also receiving that as well. So long story short, guys, like this 1099, it was because of like a missed payment from a rental property I had. Like I received, they didn't send me a balance in the previous year. I'd gotten rid of the rental property, but there was like a little bit. So when they reconciled, there was like $60 or something like that they mailed me a check for. So my property manager mailed me a $60 check in the new tax year.
Yeah.
Fast forward, I'm filing my taxes. I never got that form because my property manager sent it to like an address that was 2 addresses old. I never got it.
Yeah.
And again, we're talking about me making like $60. It changed my taxes by like $2.30.
Yeah.
Right. This is so silly.
And you got audited.
But 2 years later, I'm getting audited. But because it had been so long and between then and when I got tracked down, it ended up being like, a couple hundred. I don't even remember these numbers, but it ended up being like a couple $100 worth of like penalties and interest.
Jeez.
And so I was like, man, I get it. Like, and I there's like a form that I got from the IRS, and they're like, you can remit payment here and this and that, and like call if you have questions. So I just call, and there's this guy, super helpful, but the process took forever. I explained to him everything. I was like, look, like I have been in Afghanistan, I've been in Iraq, like I've been like training, I've been moving all over the world. Like, is there any way to at least get the interest or the penalty removed because of this is the circumstance? He's like, well, let's work on that. We worked on it. The IRS did give that stuff. It was basically taken care of. It took a year, until the next year. It was like 14 months total.
Oh my gosh.
Of me going back and forth about a few $100 to the point where I was just like,
I would have just paid it.
I should just pay it. I say all that to say
That's amazing patience with the IRS.
Like it was, and it wasn't 14 months of me calling every day. It'd be like, hey, here's the form you requested.
Yeah.
And then I'd wait 3 months to hear back. And then by then it was like, hey, I need this. So I'd send them whatever and wait 3 months to get back. So it was just a very long, nasty process. And when you go, like when you do these audits with tax preparers, and why we pay the couple extra $100 to just have it done, a lot of times you can like transfer that workload to your tax preparer company. So if you do come under an audit and it's not like you didn't lie, it was just a honest, like fat finger mistake kind of thing. Yeah. The company will actually reconcile, and you don't have to take time out of your day once every 3 months to deal with it. So kind of an amusing story. And it was literally over. I think ended up being like, I think it started out as a few $100, but then it ended up being like $1,000 or something like that. And it was just,
jeez,
it was really stupid. But anyway, I digress. Let's pause there for a quick word from our sponsors. A few years ago, I had the privilege of working with a wonderful couple that had big goals and an incredible work ethic. They made sacrifices and achieved tremendous success, and even got to enjoy an early retirement. But tragically, the wife passed away after just 6 months of that retirement life. This experience shook me to the core and led me to reevaluate how I approach financial planning with my clients. I developed an ideology based on 5 pillars of fitness and happiness, and in no particular order, the pillars of finance, faith, physical and emotional well-being, and mental health. While I'm not a doctor, priest, or psychologist, I believe in the importance of addressing all of these pillars holistically alongside financial fitness. A few months ago, I decided to prioritize my own physical health. I focused on everything from eating well to sleeping better. However, I really struggled to find the right motivation to become a regular at the gym. That's when I reached out to an old friend and fitness professional, Sean Rodman. Sean has been a warfighter in the U.S. Army for 20 years. While serving, he acquired all kinds of fitness certificates and was designated to lead fitness programs for our nation's bravest warriors. Not just the fittest ones heading off to war, but also those injured and needing rehabilitation. When he retired, he started an online fitness company, Parabellum Fitness. He builds workout programs tailored to you, your goals, and even considers your old injuries. He also switches things up from week to week or month to month, so nothing ever gets old. In just a few months, I've experienced better sleep, improved mobility, increased energy, weight loss, and freedom from my old injuries. While I want my clients to achieve incredible financial success, I believe it's all for nothing if you cannot enjoy it. Go check out parabellumfitnessllc.com. That's parabellumfitnessllc.com. Follow them on Instagram or TikTok, really any social media platform. Go follow Parabellum Fitness and reach out to Sean. Set up your first month of programming, mention Money Therapy, and get 25% off. Let's not lose sight of all 5 pillars. Together, let's focus on health and happiness and put energy into creating the best possible life we can. After all, we only get one. All right, so we'll wrap up. We got a couple more things that I want to talk about. The biggest thing that I want to say I think is important in the Q1 of things is, and really this might be something that's better to do like right after your taxes get filed, because and this is if you're a W-2 person, again, you got it easy. Yeah. But if you're 1099, if you have a business owner, like you understand like quarterly payments are important, and we're making estimated tax payments, and then we get to the point where we file our taxes and we either get a little money back or we owe a little bit of money, but ideally that gap of what we make back or owe is very small. Yeah. Because we don't want to overpay, we don't want to underpay, and we want to make sure we avoid underpayment penalties. Yeah. So typically what I say is like in the first, so if I file my taxes, let's say I get them filed or, at least get them prepared. Yeah. So I know that I've made my quarterly payments in 2023 and through tax preparation, I know I owe another, $350. That's pretty spot on. Yeah. Now the question is I made all these like great plans to grow my business. Yeah. I'm kind of through Q1 and maybe even into Q2 at this point. Sure. Am I on track? Is my revenue actually going up? Should I increase some of my quarterly payments? Yeah. Okay. Now on the flip side, if I get through the year and I get my taxes prepared and I'm going to end up getting back like 10 grand. Yeah. Like maybe I'm paying too much at my quarterly payments. I'm being too free with my money to give to the IRS. Maybe I dial that back. But the question I need to ask myself is, did I miss off of what I estimated versus what I actually owed because of like some one-off event? Or is there something that maybe my CPA, like maybe we realized I wasn't using home office deductions, or maybe I started this Augusta rule thing, or maybe there's these things that came into play in my tax picture that actually reduced my obligations to the IRS. Yeah. And so if that's the case, I can adjust my quarterly estimated payments appropriately. Again, I don't want to overpay, but I definitely do not want to underpay to the point of an underpayment penalty. Yeah. So all of that said, guys, it is so critical that I work with a tax professional on this. Yeah. But into the first quarter, beginning of the second quarter, I should be well aware of what my current year, so in this case, 2024, by April or so, I've made one quarterly payment. I should be on track now to understand, do I need to increase that a little bit? Can I reduce it a little bit? What does the rest of the year look like for me? Did I have any one-off events last year that might have triggered a higher tax return? Can I reduce it a little bit, but stay within that area that I'm avoiding underpayment penalties? So adjust, analyze, and make right your estimated taxes. Yeah. And then the only other thing that I have really, and you kind of already hit on this, is just use this opportunity to analyze your cash flows. Yeah. Recalibrate. So, and you kind of hit all of that, but just again, like our Elements app is spot on.
Yeah.
Because it makes understanding cash flows. If you're like, well, what's cash flow? It's not that complicated, but the way our app breaks it down, it's super, super seamless and simple and it's easy to understand.
Yeah.
And what's great about it is once you've adjusted your savings rate to be appropriate to fit your to help you accomplish your goals, and we have your tax rate dialed in, and we know your debt payments that are on there, whether it's mortgage or whatever, then that just tells you how much free money you have to spend, and you can spend it with like guilt free.
Yeah.
I think my burn rate right now is about 40-ish% of my income, 45, and it doesn't matter what I spend it on. Burn rate don't care. It's just money getting spent. So whether I want to go buy a new toy or put a little like extra into some home remodeling or something like that, burn rate don't care. And I don't feel guilty about it at all. So it gives permission to spend, but use the first of the year and the tax planning time to really look at your cash flows and make adjustments.
Yeah. Guys, HarpethWealthPartners.com is where you can find our emails. Ask us any question you want. We are on YouTube, Spotify, Amazon Music, anywhere you find podcasts. Apple Music.
Apple Podcasts.
Apple Podcasts. Like, view, and subscribe. Leave us a comment. If you got any questions, reach out to us in the comments, and we'll try and answer them there and or get in touch with you that way as well. Anything else?
Peace.
Adios.
I'm out. We hope you learned something valuable today. We appreciate you including us in your journey towards financial betterment. It is important to us that you know this is for educational purposes only and not to be considered specific advice for any individual listener. If something we discussed is relevant to you and you have questions about how it might be uniquely applicable to you, please discuss that with a financial professional, or, of course, we are happy to have further conversations with you about your specific questions, needs, or circumstances. We welcome you to reach out to us via our website, HarpethWealthPartners.com, or by emailing Brandon at bmc@HarpethWealthPartners.com. Securities are offered through LPL Financial, member FINRA SIPC. Investment advice is offered through Private Advisor Group, a registered investment advisor. Private Advisor Group and Harpeth Wealth Partners are separate entities from LPL Financial. The opinions voiced in this material are for general information only and are not to be intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult appropriate qualified professionals prior to making a decision. Investing includes risk, including fluctuating prices and loss of principal. No strategy assures success or protects against loss. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. Hypothetical examples presented are not representative of any specific investments. Your results may vary. We want to thank you for your time, and we look forward to having you back next week.